Hello to everyone. Today I am here with a new topic. It's impact of leverage on returns part 1. In order to grasp the concept, please watch my video till end. Secondly, if you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover the following. What do you mean by leverage? Leverage is good or bad? Impact of leverage on return, impact of leverage on WACC. WACC is weighted average cost of capital. What do you mean by leverage? The ratio of a company's capital debt means all types of the loan the company has borrowed to the value of its ordinary shares, that is equity. Equity include common stocks, retained earnings, reserves, etc. A company having no loans called zero leverage company or 100% equity based company. A company having 50% loans as a part of capital employed called moderate leverage company. A company having 80% of plus loans as a part of capital employed called high leverage company. Here one more question arises. The leverage is good or bad? If a company borrow money for revenue generating assets like machinery, equipment, leverage can be good for the company because all types of the revenue generating assets also generate incremental cash flow and the company itself pay off its debt or a major part of its debt. If a company borrow money for the luxurious asset, means non-revenue generating assets, that only add expense to the company and leverage can be bad for the company. So you will have to decide when you have to borrow the money from revenue generating and when you need the money for the non-revenue generating. It's a smart move by the finance manager or the senior management. Impact of leverage on returns. Add profit to the company if earn more than the cost of the borrowing. You have borrowed the money at 16% and you are earning from the business 20% plus. It means the difference of 4% or plus is added by the against the borrowing to your business. Leverage provide tax shield to the company against interest oblique markup. Interest and markup are interchangeable words, expense and depreciation expense. These two expenses provide the tax shield or the tax benefit to the company. It is the second concept that add profit to the company. If utilized against the revenue generating asset, the asset pay off its liability against the incremental cash flow. It means whatever the amount you have borrowed is not a burden to the company. Asset itself is paying off its liability. Here we have an example. The impact of leverage can be giant. One company is no leverage company, means it's 100% equity based. Second company having 50% capital equity and a 50% part of capital debt at the rate of 18%. So the total capital employed is same in the both cases, that is equivalent to 2 million. EBITDA in both cases is 1.8 million. In the no leverage company, there is no interest or the markup expense. And in the leverage company, there is a interest expense equivalent to 180,000. Earning before tax EBT, in first case it's 108 million, in second case it's 1,620,000. In the first case, at the rate of 30% tax, the tax comes to 594,000, and in the second case, the tax amount comes to 534,600. So the net income in the first case comes to 1,206,000, and in the second case, it comes to 1,085,400. So the return on equity in first case is 60.3%. In the second case, it's 108.54%. So you can easily judge the role of leverage if it's utilized for the right purpose is always good for the organization. Impact of leverage on WACC. WACC is the weighted average capital cost. Consider if the equity holder expected rate of return is 22% and the cost of debt is 18% and the corporate tax rate is 33%. Now here the cost of debt is 18% and the expected return of the equity holder is 22%. So with the impact of tax, the WACC reduced to 17.03%. So we can say that the leverage also play its role to reduce the cost of capital indebted within the business as well. Thank you very much. See you again with the upcoming video on the same topic very soon.